Good evening, ladies and gentlemen. This is Barry Norman on behalf of Trade Time, and welcome to our webinar on the foundations of Forex. Now, tonight's webinar is sponsored by Trade Time, one of the leading CFD and crypto providers, and they have a very unique proposition. You can personalize your entire account. You can define your objectives, set up your dashboard, and trade the world's largest market. You get account customization, you get extensive trading tools, you get fund security, and a very robust platform. It's an easy to use dynamic platform that's easy to follow, easy to see, and easy to watch, as well as getting Trade Time's leading online trading platform. So I'm going to show you a quick video, take a minute or so, and give you some information about Trade Time, and then we're going to go on with our class on foundations of Forex. So let's go on with our webinar. Tonight is the foundations of Forex. And let's talk a little bit about the Forex market and what you need to know and understand in order to trade in the foreign exchange market. Now, what is Forex? Well, the basics. Basically, the Forex market is where banks, businesses, governments, investors, and traders come to exchange and speculate on currencies. The Forex market is referred to as the FX market, the currency market, foreign exchange currency market, or the foreign currency market, and it is the world's largest and most liquid market in the world with an average daily trade over of 7 trillion. That's trillion dollars. The FX market is open virtually 24 hours a day, 5 days a week, with the most important world trading centers being located in London, New York, Tokyo, Zurich, Hong Kong, Singapore, Paris, and Sydney. Now, what makes the Forex market so different than the stock market or the commodities market is it should be noted there is no central marketplace for Forex. There is no exchange. Trading is instead said to be conducted over the counter. It's not like stocks where there's a central marketplace with all orders processed like the New York Stock Exchange. Forex is a product quoted by all the major banks, and not all banks will have the same exact price. Now, the brokers platforms like Trade Time take all of these feeds from the different banks, and the quotes we see from our brokers are an approximate average of them. It's the broker who's effectively transacting the trade and taking the other side of it. They make the market for you. So when you buy a currency pair, your broker is selling it to you, not another trader. Okay, so this is a little bit confusing, but don't misunderstand. The broker is not your enemy or your ally. The broker doesn't make profit when you lose, and he doesn't lose money when you make profit, because he is the market maker, but then he is setting off your trade into a liquidity pool, and he makes a certain small percentage of the total volume traded, not the profit and the loss, of the total volume traded. So he would be much happier on the whole if you made money steadily, because that means you'll keep trading more and more. The more you trade, the more volume you're trading, the more the broker earns. He doesn't earn by you losing your money. Now, the foreign exchange market is a global decentralized marketplace that determines the relative value of different currencies. Unlike other markets, there's no centralized depository or exchange where transactions are conducted. Instead, these transactions are conducted by several market participants in several locations. It is rare that any two currencies will be identical to one another in value. And it's also rare that any two currencies will maintain the same relative value for more than a very short period of time. In Forex, the exchange rate between two currencies is constantly changing. So I'm going to run you a short video that's going to hopefully explain this a little bit better than I do with some demonstrations. And we're going to see exactly what the Forex market is all. I give you a little bit more information and easier to understand manner. Now, the confusing part that most traders have is understanding the value of a currency or currency pair, because the euro doesn't have a value. The US dollar doesn't have a value. Now, there's a dollar index, but the US dollar doesn't have a value. The pound doesn't have a value. The only thing they get is an exchange rate between the pound and the dollar, the pound and the euro. What is the euro valued against the US dollar? What is the US dollar valued against the pound? So, for example, on January 3rd, 2011, 1 euro was worth 1.33. That means for every euro, you get $1.33. The euro wasn't worth $1.33. That's what you would get. That was the exchange rate. By May 3rd, 2011, the euro was worth $1.48. The euro increased in value by about 10% relative to the US dollar, because at the same time, it could have been worth less against the pound because the pound was going up in value. So it is the exchange rate against a particular currency. So when you're in the foreign exchange market, you're trading currency pairs. You're buying one and simultaneously selling the other. And then when you want to close your trade, you're doing the exact reverse. So for a currency pair, we quote, and there are major pairs and minor pairs, but the major pair is the euro against the dollar. So the left hand, or the first currency we state, is the base currency. So when we say the euro dollar is trading at $1.33, that's the base currency, which is the euro, will bring you $1.33. Now, you can speculate whether the US dollar value will go up or down, but it could mean that the euro is going down in value because something is happening negatively with the Eurozone economy, or the dollar could have been going up because something positive happened with the US currency. So it can change in either direction, and it could change. The euro dollar exchange rate could fall to a lesser value if the euro was going down in value, or on the other side, if the dollar was going up in value. But at the same time, the euro dollar could have fallen. That means you'll get less dollars for your euro, but the euro could have increased against the pound. So like when we have Brexit in the UK, the pound tumbled, the dollar stayed stable. So if you were exchanging your euro against pounds, you would get a lot less pounds. But if you were exchanging euro against the dollar was easing up slightly, so you would get a lot less dollars than you would euros. But overall, if you think the value will fall of the base currency, you would sell it or go short. If you think the value will rise, you would go long. So if you think the value of the euro is going to fall, you would sell euros and buy dollars. If you thought the euro was going to go up in value, you would buy euros and sell dollars, because you want to get out of the currency that is going to do less and be in the currency that's doing more. So let's try to make it an easier explanation for you. You were in London, so you had pounds in your pocket, and you were going to France. You needed to get euros to spend in France. At that point, the euro pound value was, for every euro, you would get 1.1 pounds, hypothetically. Okay. So I had 100 euros. I needed 100 euros, so I'd have to give the bank 110 pounds, and they would give me 100 euros. Now, if all stays steady, I go to France, I pay my hotel bill, and they quoted my hotel bill at 100 euros, and everything is fine. Because they're going to quote my hotel bill in euros anyway, and I have to have that amount of euros. But the problem is, If my pound went down in value, I'd have to have more pounds to pay for that hotel room. Now, let's back up. You were standing at the bank, and they told you, give me 110 pounds, and I'll give you 100 euros, because that's the value at the moment. You went to France, and you used your credit card the whole time. So you came back, and you still had the 100 euros in your pocket. You go to the bank, and let's forget commissions. Let's forget the cost of the exchange. But you go back to your bank and say, I came back with the 100 euros. Can I get my pounds back? And they say, well, the pound-euro exchange rate is now 120. So they actually hand you back 120 pounds for your 100 euros because the pound had gone up in value against the euro. So the currency exchange rate between two currencies, both of which are not the official currency of the country in which the exchange rate is quoted, is given in. This phrase is, this is what's called a cross rate. Because you see, I was quoting you the euro pound, and we were talking about the euro US dollar. You always quote the currency in the country in which you are against another currency. But if you're not in either country, okay, then you would quote it against the what's called the major. There's major pairs. So there's the euro US dollar, which is considered a major. There's the US dollar, pound US dollar, which is also considered a major. So unless you were standing in London, you would always be quoting the pound US dollar. In London, because everybody has pounds, they would always quote it first. If you're in the Eurozone, you're going to always quote the euro first because that's the currency you do business in. So you're always quoting your home country first. But then after that, if it's not in either country, you're going to talk by the majors. There's the US dollar, Swiss franc, and it's always in this position: US dollar, Swiss franc, Australian dollar, US dollar, New Zealand dollar, US dollar, US dollar, Swiss franc, the pound against the dollar, the euro against the dollar. These are considered major currency pairs. So, for example, if an exchange rate between the pound and the Japanese yen, and that's the other USD, JPY, or the yen. Okay. So if an exchange rate between the British pound and the Japanese yen was quoted in an American newspaper, this would be considered a cross rate in this context because neither the pound or the yen is the standard currency of the US dollar. However, if the exchange rate between the pound and the US dollar were quoted in the same newspaper, it would not be considered a cross rate because the quote involves the US official currency. Now, when you're trading Forex, okay, you're trading in a global marketplace and you trade on the majors. Okay. So Forex trading, as it relates to retail traders like you and I, is a speculation on the price of one currency against another. For example, if you think the euro is going to rise against the US dollar, you can buy the euro-US dollar currency pair low and then hopefully sell it at a higher price to make profit. Okay. So in the foreign exchange trading market, we make it very easy because you're not going to go you're not going to the bank and selling euros and buying dollars. You're buying a pair which has the value of the euro-US dollar. So you would go on your platform and say you would buy 10,000 euros worth of US dollars. Okay. If the euro goes up, you would then sell it and get the profit between the value then and the value later. You could also sell the euro-US dollar because you think it's going to go down. So, of course, if you buy the euro against the dollar and the US dollar strengthens, you will then be in a losing position. So it's important to be aware of the risk involved in trading Forex, not only the reward. So imagine a situation where the US dollar is expected to weaken in value relative to the euro. A Forex trader in this situation will sell dollars and buy euros. If the euro strengthens, the purchasing power of the dollar has now increased. The trader can now buy back more dollars than they had to begin with, making a profit. So this is similar to stock trading. Stock traders will buy a stock if they think the price will go up in the future, or they sell a stock if they think the price will fall in the future. Similarly, Forex traders will buy a currency pair if they expect its exchange rate will rise in the future, and sell a currency pair if they expect the exchange rate to fall in the future. So again, if you've ever traveled overseas, you've made a Forex transaction. Take a trip to France and you convert your dollars to euros. When you do this, the exchange rate between the two currencies based on the supply and demand determines how many euros you will get for your dollars. And the exchange rate fluctuates continuously. Now, in the Forex market, we trade in currency, correct? But currency doesn't move that much in value. Currency is quoted 4 digits to the right of a decimal point. So when we quote the euro US dollar, and is today trading at hypothetically 121, it's actually at 121.425. That's all the way over there. So right now, for every euro, you get $1.21.4 because the currency market doesn't move that much, because you can't have currency surging up and down in value. People not forget the Forex trading market. You couldn't even quote an overseas purchase. You couldn't buy something on Amazon to have shipped in because the values would go up and down. So currencies trade and they're stabilized by the central banks, and they maintain a rate. They could steadily over time decline, or you could have events like Brexit or the Greek mess, a couple years ago, or where the euro fell continuously, but it didn't fall overnight. It's still, the euro fell from 134 down to 108. Well, that sounds like it's a lot, but really, it went from $1.34 to $1.08. Okay. In reality, because you trade currency in huge blocks, that can amount to a lot of money. But in essence, if it was the difference between what you had to pay in the store to buy a candy bar, would it really affect you if the candy bar was $1.34 today, and a month from now it was $1.18? You might say, the price fell, but it's not going to whether you buy or sell a candy bar. Okay. Now, in the foreign exchange market, there's a lot of big players. There's the central banks, there's commercial banks, there's brokers, there's individuals, there's hedge funds, and there's companies. And then come you and I. We're just little speculators. Okay. So somewhere we fall in that mess. We're retail Forex traders. So finally, we come to the retail Forex trader, you and I. The retail Forex trading industry is growing every day with the advent of the Forex trading platform and their ease of accessibility of the internet. Retail Forex traders access the market directly, either through a broker or a bank. There are two main types of retail Forex brokers that provide us with the ability to speculate on the currency market. That's brokers and dealers. To deal with a dealer, you have to have a huge, significant amount of money. Okay, so all of us on the whole deal with brokers. Brokers work as an agent for the trader by trying to find the best price in the market and executing on behalf of the customer. So this is what a broker does. Like I said, he does not make profit and loss based on your profit and loss. He is not against you, and he is not for you. He is going to get you your trade at the best price possible. Now, for this, they charge a commission on top of the price obtained by the markets. In the Forex market, with retail online brokers, it's what we call a spread. Okay, it's the difference between a buy price and a sell price. And there's a couple pips. It's decimals over to the right. Okay. And this is what the broker charges you, because he's got to pay his overhead. He's also got to pay the electronic fees. He's got to pay the liquidity provider. He's got to pay the insurance. He's got to pay everything. And so for this, they get a small spread. So if you, I don't know, you guys all vary in age, but when I was younger, and you would want to convert your pounds to euros or your euros to US dollars, you go to the bank and they would give you the best quote possible. And for that, they'd give you the exchange, and then they would charge you a commission. Okay. Today, if you go into the bank or a currency exchange location, you can see that they say they'll buy euros at one price and they'll sell you euros at another price. The difference between those two prices is called the spread. So that's how even currency, commission places on the street corner that convert your currency, or even when you're in the hotel on vacation and you need to get your euros to dollars or your euros to pounds, and you go to the front desk, they have a buy price and a sell price. Now theirs is a bigger spread because the hotel is making money on top of the commission store. But this is the difference. But still, it's a small amount of money, unless you're doing, and even if you're just doing 100 euros or 50 euros, it's a small amount of money. Now, there are many reasons to trade in this market. Forex is the largest market in the world with daily volumes exceeding $6 trillion. So we've said 5 trillion, we traded 6 trillion, we've also said 7 trillion. It's because it's growing exponentially by the day. Okay, it's becoming, it is a huge market. But today, the average is quoted at $7 trillion. A year ago, it was a 5. At the end of 2017, it was 6 trillion. That's a day, not a year. That's $6 trillion a day. Trade whenever you want. There is no opening bell in the Forex market. You can enter and exit a trade virtually 24 hours a day, 5 days a week. You can fund your trading account with as little as $250, as many retail brokers. And you can trade, and they offer many currency pairs. The nice thing is about volatility in the market allows you to profit in any market condition because you can sell or buy. So when we have Brexit that said the pound tumbling, you can make profit. Okay. When we had, like I said, the Greek mess in the Eurozone, every time Donald Trump does something and the dollar goes up and down in value, you can make money because there's a lot of movement and action in the currency market. So while the Forex market is clearly a great market to trade, I would note to all beginners that trading carries both the potential for reward and risk. Because understanding and knowing how to trade these pairs is a little bit complicated because it involves global news, global headlines, as well as economies of each country. Okay. But it doesn't take that much. You have technical analysis and fundamental analysis. You have trading strategies. But one of the biggest benefits of the Forex market is called leverage. Okay. Leverage allows us to trade a much larger portion of the market than what we could normally afford. So in other words, with a 50-to-1 leverage, okay, you want to trade $1,000 worth of the euro, you'd only have to have $20. So in other words, if you have $200 in your account, you can take a position equal to $10,000 worth of euros. That means even though that these assets only trade in pips, which is a very small amount of money, because you have a much larger position, you can make profit. Now, we're not talking about getting rich. If you have 10,000 euros and the euro moves up 2 pips, 3 pips, 5 pips above the cost and the spread, well, you only made 50 bucks. But it gives you that advantage to make 50 bucks. If it goes up 10 pips, you make 100 if it goes up 20 pips. And that's 4 decimals to the right. A pip is a unit you count profit and loss in. Most currency pairs, except the Japanese yen pair, are quoted to 4 decimal places. The 4th spot after the decimal is 1/100th of a cent. It's typically what one watches to count pips. So in other words, when I say the euro went up 10 pips, it went up 10/100ths of a cent. Okay. Now, it can move 100 pips in one day. That means you could have made $1,000 on your couple dollar investment because of using leverage. So this means that you can take advantage of even the smallest movement in currency by controlling more money in the market than you have in your account. Now remember, on the other hand, leverage can significantly increase your losses. Trading foreign exchange with any level of leverage may not be suitable for all investors. The specific amount that you are required to put aside to hold a position is referred to as your margin requirement. Margin can be thought of as a good faith deposit required to maintain the open position. This is not a fee or a transaction cost. It is simply a portion of your account equity set aside and allocated as a margin deposit. Now, just like stocks, you can trade a currency pair based on what its value is or where it's headed. The big difference with Forex is that you can trade up and down just as easily. If you think a currency will increase in value, you can buy it. If you think it will decrease in value, you can sell it. With a market this large, finding a buyer when you're selling or a seller when you're buying is much easier than other markets. So it's always subject to liquidity, but the liquidity is huge in the foreign exchange market with $6 trillion being handled every day. So it means, if you buy stock, sure, if you buy stock in Amazon, okay, it's got lots of trades. But the fact is, when Amazon was falling the other day and was falling down 6%, could you find a buyer at that moment for you to sell off your Amazon stock? Maybe not, because the buyers were all waiting for it to fall farther. So there was no buyers available. Okay. The buyers will come back to the market, but at what price will they come back to the market? Don't have that in the Forex exchange market. Maybe you hear on the news that China is devaluating its currency to draw more foreign investment into its country. If you think that the trend will continue, you can make a Forex trade by selling the Chinese currency against another currency, say the US dollar. The more the Chinese currency devalues against the dollar, the higher your profits. If the Chinese currency increases in value, you have to sell your open position, and then your losses increase, and you'd have to get out of your trade. So if you have an opinion, now what? Open a free Forex demo platform and trade your opinion. Okay, you can go to Trade Time, open a demo account, and try it out. Just use your opinions. Watch the news, watch the headlines. Is the pound going to go up? Is the euro going to go down? What do you think Trump's going to do? What do you think the election do? What do you think is going to happen to the pound when they have the UK mayor's election? Because all Forex trades involve two currencies that you're betting on the value of the currency. Now, when you're trading on margin, fractions of a penny do count. So you can get a much larger position in the market with a much smaller capital investment. So remember, the Forex pairs are traded by their nicknames. The US dollar is the USD US dollar. It's traded against most of the major currencies. These are the major currencies you're looking at. And the major pairs are the euro, which is the euro US dollar. Always quoted that way. Euro against the US dollar. The euro being the base currency. Then you have the dollar yen, which is always the US dollar against the yen. Then it's opposite. It's a pound against the dollar, which is nicknamed cable. You know why? Because there was the cable laid under the Atlantic Ocean connecting New York to London, and people were always asking if the cable came in with the price, because it used to be the central banks which set the trading price, and since London was the major trading center for currency, they would wait for the cable to come in. Then you have the US dollar Swissy, which is the Swiss franc. You have the US dollar Canadian dollar, which you asked me why that's a major commodity, a major currency. Nobody's ever figured that one out, but it's the dollar Canada. Then you have the Australian US dollar and the New Zealand US dollar, which we referred to as the Kiwi. These are the major currency pairs. Now, you need to understand how to properly read a currency pair quote before you can start trading. So when you see the currency quoted on anywhere, particularly on a website, you'll see the euro US dollar. The euro is the base currency. The US dollar is the quote currency. So the left-hand side is the base, the right-hand side is the quote. So when you see it's equal to 132.105, that means for every euro for the base currency, For €1, you would get $1.32 US dollars. And then you have the bid-ask price. Now remember, I told you this is the new way of charging commission. So you have the price you would sell the euro-US dollar pair for. So it's 136. And then because we're only really concerned with the pips, it's at 136.407. Okay, is the sell price, or known as the bid price. The buy price, if you want to buy the currency pair, is at 136.428. The spread is 2.1 pips. So the bid price is the price at which the market or your broker will buy a specific currency pair from you. Thus, at the bid price, a trader can sell the base currency pair to their broker. The ask price is the price at which the market will sell. Remember, if you've ever been to the bank, the hotel lobby, or the commission currency store, these are the two prices you see hanging on the wall or on the electric sign telling you what price they'll buy and sell it for. So the difference in the price is what, in essence, the broker is making, and not his profit. It covers, like I said, all the electronic fees through the liquidity provider. It covers his insurance, his operating costs, his cost of doing business, the credit card fees that your bank charges him to take money in and out of your account. So remember that. So the brokers don't gouge you. They're not against you or for you. They're just in business to facilitate your trading. So the difference in the bid and the ask price of a currency pair is referred to as the spread. Now, what affects currency values? Okay. Currency prices are influenced by a multitude of different factors, from international trade or investment flows or economic and political conditions. Some of the key factors that influence Forex prices are political and economic stability, monetary policy, currency intervention, natural disasters and earthquakes, tsunamis. Okay. Now, how can you make money through Forex trading? Buying low and selling high, or selling high and buying low, is the base of making money in Forex. It's also the base of making money in the stock market. Basically the basis of making money anywhere. So for example, if you buy the pound against the US dollar, when each pound is equal to 195.954, and then sell it when it's equal to, valued at 2.2035, you have made a profit. I don't want to focus on more detail in this class and explain how the profit and the money are being calculated. I will talk about these subjects at another time. Okay. The big question is, how can you find out the best time to buy, and how can you predict if you should buy or sell a currency pair? Now, this is the million-dollar question. But if you learn Forex trading properly, you can make a lot of money. Forex can be your full-time job that makes thousands of dollars every month. But I have to emphasize again that if you're starting to work on Forex before you learn it properly, it can be risky and you can lose your money. It's like driving. If you drive a car before you learn how to drive properly, you will hurt yourself and others. But if you learn it properly first, driving will be a pleasant and enjoyable experience. You can make a lot of money by spending a small amount of money because of leverage. Unlike other investments like the stock market, you have to invest a lot of money to make a reasonable profit. You can make a good income through investing small amounts of money. It means you do not have to have a big account. You can start off with a small account, grow it, and have a reasonable account after a while. So these are the basics of Forex. Think about them. If you want to get started, come to our other webinars and start learning how to properly understand the markets. And this is one of the reasons there are demo accounts. Do not risk your money. Don't think you're going to get rich overnight. Use a demo account. Slowly learn. Understand how the economic factors, how the news and the headlines, what currency pairs should be valued at. Understand how to read charts. And slowly, once you've had your demo account for a while, once you've had at least 2 months of successful trading on a demo account, then you can start trading real money. But don't make the mistake that you think you're going to get rich overnight without learning. because it's like a job. It isn't a gamble. It's not casino in Las Vegas where you toss your coins on 17 and hope and pray the wheel comes around to 17. Okay. Once you understand the markets, you can trade profitably and successfully. So on that note, I'm going to say goodnight to y'all. Thank you very much for joining us. And go to www.tradetime.com and open a demo account. Set it all up. There's no credit cards required, no deposit required. And start using their demo account to start learning the Forex market. Have a good night, have a good week, and have a good holiday. Thank you now. Bye.